bond market is in a bubble. The bond market is in the biggest bubble we've ever seen. And, I'm thinking 2028, 2030, we're going to have a meltdown on our hands, and it's going to be astronomically bad. You've heard me mention it before. The bond market is something that you can't really manipulate, or at least it was once believed you couldn't. Based on what we're seeing today, the bond market is falling. Now, the question as to why it's falling, well, that's what we're here to discuss today. So let's look at it this way. One economist puts it as trading a can of sardines. Basically, in essence, you buy a can of sardines, primary market, for $10. You then put it on the secondary market, sell it again for $20. You've now doubled your investment. The guy who bought the can of sardines for $20 sells it to another investor for $40, all in the secondary market. That third investor takes that can of sardines that he purchased for $40 when it originally had a face value of $10. He has bought the can of sardines, decides to open the can of sardines to find that all the sardines in there are raw. They've gone bad. So that investor, the third guy who paid $40 for this can of sardines, goes back to the second investor and says, hey, these sardines are bad. Why did I pay $40 for something that clearly is bad? And he says, what did you expect? They were a can of sardines. That's what's going on with our bond market right now. The bond market is going to negative rates. They're going to factor in the negative rates. And the Fed has begun buying these bonds to create, as our Fed chairman, Jerome Powell put,
we print it digitally. So we as a central bank, we have the ability to create money digitally. And we do that by buying treasury bills or bonds or other government guaranteed securities. And that actually increases the money supply.
Digital money, free money out of nothing. How do they do that? Well, if you look at this article, clearly ECB, the European Central Bank, has already done something like this. They buy it, pay a premium for it, sell it again, rebuy it, and because banks are required to buy bonds by the government, there's no limit to what this can do. Of course, it's going to have an impact. So bond rates continuously go negative. Now, negative rates don't mean anything for it. People will still pay premiums. And if you look at this, the Australian 100-year bond is astronomically high because people just keep paying premiums for it. That's our bubble. We found the next bubble, and it's within our bond market. It's happening year after year. People keep paying premiums for it. Again, that's why it's all unstable. You can continuously do this, and the only people that benefit from this are asset-holding wealthy individuals. Clearly, asset holding meaning equities. Anybody holding stocks are going to astronomically increase from this because nobody wants to have bonds that aren't yielding any return. If rates go negative, who's going to want to buy a bond? Well, the only people that are stuck with it are those that are beginning to pay premiums for it year after year. And eventually, when those premiums expire, their year to date, their year to maturity will collapse. The bond market is in a bubble. The bond market is in the biggest bubble we've ever seen. And, I'm thinking 2028, 2030, we're going to have a meltdown on our hands, and it's going to be astronomically bad. So how do interest rates come about this? Interest rates and actual bond rates are two different things. A lot of people get them confused, but let's look at the bond percent, the bond rate that can be influenced from the Federal Reserve's interest rates. So let's take a look at the negative interest rates, the ones that we talk about. Negative rates can create just as many problems as they can potentially solve. By keeping them extremely low or negative, central banks begin to misprice risk. This leads to asset bubbles, which is currently what we are in. Also leads to unproductive investments and risky yield-chasing behavior. Yield chasing being the yield return on a bond. This leads to a disastrous impact on commercial banks, pension funds, and anyone with an inlinking of common sense. Negative yields are almost as silly as negative rates, but in some cases there is a logical explanation for them, even if that logical explanation is a massive bond bubble. Let's clarify something real quick. Interest rates are the rates banks charge to lend to each other, such as the Fed's fund rate within the United States. The coupon rate is typically a fixed rate that a government or a corporate bond pays year over year. 3 to 5% is the norm. Well, not anymore actually, but just for example here. If the government issues a bond that has a face value of $1,000 and a 3% fixed coupon rate, it pays $30 on that bond each year until maturity. Even if the market price for that bond rises to $1,200 or $800, the government keeps paying $30 in interest each year because the 3% applies to the face value of that bond. A bond's yield can refer to different concepts, but for this case, we're gonna look at the yield to maturity. That's what we're gonna be focusing on here. The yield to maturity is different than the coupon rate because because it also depends on the bond's current market price and its redemption value, or how much you'll earn back at the end of the bond's expiration. Credit quality and prevailing yields on similar bonds in the market also affect the yield to maturity. If similar companies start issuing bonds at higher yields, the older, more existing bonds will become less attractive. So all these companies that have begun issuing enormous amounts of money through bonds trying to raise capital right now will push down the older bonds market price. So the Fed is clearly buying all this debt to basically push down the price of their old bond and raise the price of the new ones. Yeah, it's as confusing as it is, as everything in the market is right now. The lower market price then increases the yield of the company's existing bonds, pushing it closer to current market yields. If you don't think bonds with negative rates exist, just look at Denmark. Denmark is a prime example of a whole country that's yielded tons of negative coupons. So as an investor, you get to pay someone else for the privilege of lending them money. Yeah, even I had to think twice about that for a second. But hey, if the bond's price falls low enough, a negative coupon could still produce a positive yield. In the current economy, most bonds with negative yields are zero coupon bonds issued by countries like Germany and Switzerland. Investors bid up the price of these bonds as soon as they're issued. This basically reverts back to our economist point of view on the can of sardine trading. So if the bond's face value is $1,000, maybe its market price immediately increases to $1,020, and therefore after on the secondary markets just keeps increasing, leading to a bigger and bigger bubble. In this aspect, with a 10-year maturity, a 0% coupon rate, and a redemption value of $1,000, the yield to maturity on this end is 0.2%. See, $20. Although interest rates, coupon rates, and yields are different concepts, they are all connected. For example, if overall interest rates in an economy are lower, then coupon rates will tend to be lower because they're often based on an interest rate spread. Lower interest rates and lower coupon rates often mean that yields will be lower simply because bonds produce less interest income. As yields fall, prices rise, and as prices rise, yields fall. Hence why our bond market percents have been dropping. So again, if you're looking into the bond market, they will be decreasing, but they'll still be returning profit so long as they're sold before their maturity. Hence why I believe the bubble will begin to burst around 2028, 2030, because then bonds will have begun to expire from 2008, which is when the Fed began buying everything up then. So investors, the Fed, might buy a negative yielding bond if they believe the overall interest rates, and therefore market yield, will fall even more in the future. So they then can sell for the bond at a higher price. Some investors also buy negative yielding bonds as a currency play. And if you look in our economy today, currencies across the globe have been fluctuating up and down, mainly decreasing over time. With appropriate currency hedging, a negative yield can turn into a positive one, such as when US investors buy a European bond and the USD EUR hedges. But the first example I gave is a simple, more common use. Investors buy negative yielding bonds because they believe the bond price will increase in the future. If you think about this for just 5 seconds, you realize how insane this actually is. Hey, you don't have to be a genius to realize this is a failing system. But that's where the bubble is. Traditional bond investing is supposed to be about earning interest income with some possibility of modest capital appreciation. But negative interest rates and negative yields have turned the bond market into a casino where buyers keep waiting for the greater fool to come along and purchase it. If you don't believe this casino mentality, take a look at the Australian 100-year bond. If you saw the cover photo of this video, clearly there is something going on here. It is an enormous bubble, and this will happen across the globe as central banks across the world begin to purchase more and more bonds, thus increasing the price of them over time. Because of the long maturity of these bonds, their duration and convexity are very high, making them extremely sensitive to small market yield changes. These bonds are up 70% in 2019 and trade at over 200% par value. Does that sound right? So what's the end result of all of this? Well, clearly, bond prices will plummet. Buying negative yielding bonds only makes sense if you plan to sell them before their maturity, which I'm pretty sure the Fed is just going to wait for some fool to come along and sell these bonds. Hence why they probably just issued that new 20-year bond to pay for all of this. But what if the greater fools disappear? What if everybody begins to realize this is one big bubble? Almost anything could cause that. Clearly, we saw with this coronavirus that is a potential for that to happen, and now all these new bonds are entering the market. What's going to happen with these previous ones? What's going to happen to these new ones as another occurrence happens? Trade war occurs. What if something like that? What if another virus comes about? How do you stop the next bond market collapse? And when they expire, what happens to all the people that overpaid billions of dollars for these bonds. Guess we'll have to wait and find out. This is uncharted territory across the globe. Centralized banks everywhere are beginning to do this. And, it's only a matter of time before something blows up the bond market. So be mindful of that. This is Investing 101. This is the bubble. Watch it.